Hey, what's up, my uplifting life partners? This is Ron Simplified Myers. For those of you who haven't had the opportunity to hear from me in the past, first let me say welcome. Thank you for the support. I am the author of the book, The Relationship Success Handbook. Get rid of your problems, not your partner. Now, today I wanted to talk a little bit about life insurance, understanding term insurance versus cash value. I'm going to go through. When I get through, you guys will understand this better than majority of life insurance agents. And when I say majority, I mean majority. It's probably over 90% of the agents out there are basically doing a presentation that was taught by their company, and that's what they're doing in the home, and they're selling products that are best for their company and them, and not what's best for you. So this understanding, and I always tell people, even when I was in the industry, I was in financial services for about 30 years. And I used to tell clients all the time, because they'll be like, well, Ron, we trust you. And I go, that's cool. But it doesn't matter what I know, it's what you know. Because if something ever happens to me, who's going to take care of your finances? Who's going to keep you away from the wolves that I'm trying to educate you on to begin with? See, I tell people, I'm not telling you your agent is a bad agent because I don't know them, or that they're bad people because I don't know. Some people are just not informed. But it is very important what you know, so that when people make decisions, when you're making decisions, you know what's best for you. And you can also pick out very quickly if the representatives there to help you are what's best for him and his company or her company. All right, so let's go through this. If you haven't got to see the previous video I did on the significance of life insurance, it's very crucial that you have it. And when you have it is very important also. So go back to the previous video, watch that. But let me go on this one and explain so you'll understand the differences between what they call term life insurance and cash value life insurance. Now, term. Okay. Term just means, making sure you guys, the glare is not messing you up there. Term is just basically like auto insurance. You have a certain term, which means what is the policy telling you as far as how long you're covered, that type of stuff. It may be a 6-month term. That's the length of that policy. It's a 1-year term. That means it lasts for a year. If you're serving in office, like in the political field, example, president, they have a 4-year term. That means they serve for 4 years. So I hope you guys understand that the term is just specifying the fixed amount of time that you're doing something. So life insurance, real quick, term, life insurance would mean, what is the term? How long is this particular policy going to last? You can have a 20-year term, and all that means is your life insurance is locked in the rates for the next 20 years. That's why it's called 20-year term. That just tells the length of time. You can have a 20-year, well, let me go through and explain the different insurances to make it real simple, okay? Now, what they have, understand the concept of life insurance. It's real simple. The older you get, the better chance it is you're gonna die, right? You're getting older. The risk is higher because you're getting older. Now, life insurance company is not gonna pay that risk. They're gonna pass that on to you as the consumer. Think about it. If you're in business, all the expenses, you're trying to get the consumer to pay it, because if not, then that means you have to take it out of your profits. So therefore, you want to make the consumer pay the expenses. This is from a business perspective. Now, I know as a consumer, we want them to eat it all, but let's deal with a business. They couldn't function if they paid all the expenses and made it basically free for you. So they're going to increase every year as you get older. The risk is higher. It's going to cost them more money, which means they're going to charge you as a consumer. So your life insurance rates would go up every single year. That's known as ART, or annual renewable term. Again, term just means this amount of time, and what is this policy actually doing? What are the terms about this particular program? And what it's basically saying, the term here is annually we're going to renew this insurance annually. That means, again, every year you're getting older. Every year is getting more risky. Every year you're going to renew it, which means every year is going to cost you more money. Now, the example to make this real easy again is you say you have $100,000 worth of protection, life insurance. If something happens, this is the check you want them to cut your family. And you're going to pay $25 a month every month for the first year. Next year, you're older, it's more of a risk. They're going to charge you $27 a month for the same 100,000. See, it's getting more expensive. And it keeps going on and on. Okay. Now, what the industry realized is that they wouldn't be able to survive like this, because what's going to happen is, guess who's going to drop the policies? All the people that are healthy will start to drop these policies because they're getting too expensive. Guess who keeps the policies? The people that are sick, that figure any day now I might go, so I got to keep making sure I pay these premiums so you can cut that check. Does that make sense? So the industry is in a bind. It's like, what do we do if this is happening? Because we don't want all our good people leaving and we are stuck with all the sick people. So they came up with what they call DT, or decreasing term. Again, we understand term just means the amount of time this program, or what are the terms of this particular program. Now, decreasing term, the way it works is they said, let's do this in reverse. You're paying $25 a month for that 100,000, but you don't want your price, your monthly amount to go up. You're like, no, I want to stay at the $25 a month. And they said, so what we'll do is decrease the insurance. So the second year, you're paying $25 for $99,000 worth of insurance. The next year, maybe it'll drop to $98,000 worth protect. You guys see? So you could continue to pay the $25 a month. So if you notice, isn't the insurance getting more expensive? Yes, because you used to pay $25 a month for $100,000. Now the third year, you're paying $25 a month for $98,000. This is the way, and if people understand the concept, what I talk about, the theory of decreasing responsibility, which means in the early years, you have a lot of expenses, as far as the kids, schooling, work, your mortgage, your credit cards, you got a lot of expenses, but what young couples usually don't have is a lot of money. That's the purpose of life insurance, is to make sure, and again, that's the significance, go back to that video, but that's the reason you get it, because I need to make sure my family's protected in the early stages. But I'm going to start to accumulate cash so that in the later years, I don't need insurance because I have cash. So this concept works in the sense that you're saying your need for insurance is actually going down, but you, at the same time, didn't want your premiums, the amounts you're paying monthly, to go up. Now, what they did is, for financial planning purposes, for a family, you may say, you know what, I want my protection to stay the same because I want to stay at the 100,000. I want to make sure I have that amount of protection. But I want my rates to lock in, so I want both. I want my insurance to stay consistent. I want to stay with that 100,000, but I want my monthly amount to stay the same. So what they did is using ART, folks, if you understand, this is the basis of all life insurance. No matter what an agent tells you, this is the basis of all life insurance. The older you get, the more risk, they're going to charge you more money. All policies work that way. The decreasing term is still doing the same thing, it's just in reverse. You are getting older, the risk is higher, so therefore, the insurance is costing you more money. Remember, $25 now, we're paying for $98,000 the third year. It all works the same. Now, what they did is they came up with what they call, I'm gonna go with a different color on this one, but they went to what they call LT, which is called level term. Again, we understand term just means the amount of time or what this particular policy actually consists of, but we want it to be level. We want to stay with this $100,000 worth of protection. But they said, oh, okay, now if we're going to lock in the rates, we may do a 20-year level plan, which means we're going to lock the rates in for 20 years where your rates will stay the same and your amount of protection will stay the same. So how do we make that possible? We're going to use annual renewable. If you guys remember, this is the basis of all life insurance. You're older, the risk is higher, we're going to charge you more money. So they use ART to figure out over the next 20 years, that's why it's a 20-year program, how much is it going to cost this person using the ART, would it get more expensive every year? And then they kind of average it out, okay? And they average out, once they figure out, let's say it's $100 over 20 years. That means it's going to average out to about $5. And I'm just using that. You guys know the number is going to be a lot higher. So basically, they're just saying, okay, it's going to be $5. It was $100 for the 20 years. For 20 years, the average would mean it's about $5 per year in premium. So then they'll turn around and they'll charge you the $5. But in this example, just so you guys understand, to stay consistent, what they're going to do for the 100,000 is they may charge you $40 a month is what the premiums are. And people go, wow, but that's more than the 25. Exactly. Because they used it annual renewable and they averaged it out. That's how they come up with this number. But what this is going to do is it's going to keep you with your 100,000 worth of protection. And your monthly is never going to change. You guys get it? That's how they have what they call level term. All insurance policies are going to have one of these three inside the programs. Some of the policies will have two of the three. Some of them are so the way they work them, they got all three of them working inside the same program. So, but anyway, so what the industry did, if you guys understand term, this is the basis of all life insurance. This is it. That's it. Once you guys understand this, you understand life insurance. Any agent walks in your house and badmouths term, get them out of your house. Because that means one or two things. They're an uneducated agent, which of course you will want that person doing your financial planning for you. Or they might not, because I'm going to use the political way to say this, they might not be there in your best interest. I'm not going to tell you my true thought process, but you can imagine what it really is, how I really feel about it. Because I just told you they're either uneducated or they just might not be there to do what's best for you. Because what the industry did is they took term insurance and what they did is they added a cash account to it, a cash value, which they call a savings account, a college fund, a retirement account, whatever you told them you need, that's what they called it. If you said, well, I'm looking for retirement, they go, well, we're having a retirement account and we're going to also give you life insurance. But here's the key. The life insurance part is always term. That's why I said if an agent ever badmouths term, get them out of your house. Because they'll sell you on what you say you want, which is a retirement account. If you say it's for kids' college fund, I'll send you a program. Great to send your kids to college. And we'll throw in some life insurance. Folks, the life insurance element, I had an agent when I was new in the industry, wanted to challenge that. I said, well, when does term life insurance pay off? As far as when do they get the check? He says, when a death occurs. I said, okay. In a cash value policy, when will they cut the check? He said, when the person passes away. Interesting. Happens at the same time, huh? See, folks, look inside of your life insurance policy and you will see, if you understand what I just told you, every single policy, life insurance policy in existence has one of these three elements, or again, two of the three or three of the three, but the bottom line is you can never get away from the term element. They just added a cash account, and depending on what that cash account is or does, will determine on whether it's going to be called whole life, variable life, universal life, you bet your life, whatever. So if you guys understand what I just said, all policies term plus a cash account, that will give you your other programs. That's why the concept of what I believe and teach, buy term in its purest form if you're looking for life insurance. If you buy car insurance, you buy fire insurance, more earthquake insurance, any insurance we can think of in existence, do you add a savings account, a cash value account to it? And the answer is, of course, no. People go, well, that would be stupid. Why would I buy health insurance and attach a cash account to it? Doesn't make any sense. How did you get convinced? Well, I know how you got convinced, because the agents were taught how to present it to make you think it was good. Why would life insurance be any different than any other insurance? It's not. But the industry has made a killing, literally, on families because of a lack of the knowledge. So if you guys understand what I just said, you understand life insurance better than majority of clients. You could actually take the information that I just gave you. If you have a policy with a cash account, you can go look in your policy and you will see the insurance element is doing exactly what I told you. Even though an agent will tell you, well, that guy misled you, your premiums are never changing. You see, we've been paying you, charging you $25 a month. It hasn't changed. I said, now go look in your policy and look at this cash account and notice how in all these earlier years, you have no money. Why? That's what they were using to pay the increase in premiums. You'll also notice in a lot of these programs how the cash value is starting to decrease. You had $1,000, now it's down to $850, and then it's how you're not taking any cash out. How is your cash account going down? Because instead of billing you and charging you more money monthly, they're taking it out of the cash value. It should be illegal to tell someone your premiums are not increasing, which is why they say it, because it's what you're paying out of your pocket. They're calling premium. So that's why they can say your premium isn't increasing, but your cost of insurance is going up every single year. And if they don't bill you, they're taking it out of your cash account. And what happens with a lot of families is 10, 20 years from now, they all of a sudden get a bill telling them their premiums went from $25 a month up to they have to pay $500 a month or their policy will lapse. That should be illegal. Just my opinion. So again, if you guys understand what I just shared with you, life insurance is not very complicated. The industry has tried to make it seem that way. They wouldn't be able to sell these programs if they didn't make it seem complicated. So I will go into more detail and give you guys a very clear understanding in the next video of cash accounts, how they work. But in the meantime, if you understand this, you understand life insurance. Not complicated, very simple. Older you get, there's a risk. I'm going to charge you as the consumer for that risk. Or I can turn around and say, you know what, I'm going to do it and decrease the insurance, keep the premiums the same, or I'm going to figure out and average it out. But again, it's all based on this one thing here, annual renewable term. And as you guys know, it ain't right, it ain't wrong. It is my opinion. Now, if you haven't had the opportunity to watch my videos, run over to ronsuchannel.com. That's the letter U, ronsuchannel.com. Subscribe. Give comments, feedback. I'd enjoy that. If there's certain topics you want me to talk on, let me know that also. And for those of you who said, I thought he was a relationship guy, what is he talking about finances and life insurance? Because I was in the industry, like I said, for over 30 years. And my passion is to simplify life and relationships. And finances is a major topic in relationships. And those that know what I teach know that I believe finances is not the reason for divorce, even though the world is, again, teaching that, at least in our society, is teaching that it is the number one reason for divorce. It's not. I sat across the kitchen table for 30 years. I can tell you it's not the reason. It might be the number one topic, but it's not the reason. And the reason I say that, two people committed to each other will be homeless together. And also, the rich continue to get divorced. So obviously, that's not the secret. Money is a topic, and we either in this thing together or we're not. So again, as you guys know, the way I love to end is to tell you, if you're not having fun, you should be doing something else. Play this back again if you need to. Really understand this is it. When you understand that, life insurance is simple. I'll talk to you guys later. Take care. Bye-bye.